Money FM 89.3. Best of breakfast. The bigger picture, only on Money FM 89.3.
Good morning. Welcome to The Bigger Picture. Me, Ryan Huang. In quite a rather uncertain backdrop right now, with all the shifting macroeconomic tides, Asia's local currency bond markets are emerging as a compelling destination for global investors. And in the mix, we've got a confluence of rising U.S. fiscal deficit, a weakening U.S. dollar, subdued inflation across much of Asia, and much more that is driving that case. And to talk about it today, we've got Goh Rong Ren. He is a fixed income portfolio manager for Eastspring Investments. Rong Ren, good morning. Thanks for joining us on the show today.
Good morning.
So let's talk about what we are facing this year, where we've got a lot of uncertainty playing out. But we started the year actually quite optimistic with how markets have been going or what we've been expecting. So walk us through what has been your takeaway so far this year. You have been on this overweight view on Asia local currency bonds for a good part of this year. How much has changed so far?
As a backdrop, for the longest time, we are talking about several years, the US economy has been exceptional. And this is why money from all over the world has been flowing into US assets, be it US fixed income. Well, US treasuries had one of the highest yields in the developed markets. And of course, we know that US equities have outperformed most of other markets over the past 4 to 5 years. But something changed this year with the election of Trump. He has actually shaken this edifice of confidence markets have had on US assets, primarily because of the uncertain and erratic policies he has introduced. For example, tariffs. Not too sure if you have heard last night or over the past few months, he has tried to influence Fed decisions. So, the level of confidence has dropped, and with it, the level of confidence in US-based assets have dropped proportionally as well. So this brings us to the other side of the equation. The stars appears to have been aligned for Asian local bonds starting from this year onwards, associated with this strong narrative about, the dollar dominance being challenged. So King Dollar is no longer the only game in town. It used to be the case that Asian local bonds were not so attractive when the dollar is strengthening. But now with dollar on a weakening trend, it appears that a combination of other factors, such as accommodative monetary policy, which will lead to lower bond yields, would make this asset class pretty attractive. And plus, you have the benefit of currency appreciation in all these currencies from this structural dollar weakening trends. So in combination, this would make Asian local bonds pretty attractive.
Okay, so how much momentum is there in this move? How sustainable is this? Because there's always been some chat about how folks have been trying to move away from the dollar. It's happened a few times, but there is always that case that the dollar is irreplaceable.
Don't get me wrong, King Dollar is being challenged, but I don't think it's going to be dethroned anytime. But let's put this dollar dominance and dollar strength theme into context. So from peak to trough over the last 5 years, we are talking about a 20% appreciation in the dollar, the broad dollar. And right now, it has corrected about 10%, which means that there is actually room for the dollar to weaken further, which actually augments the case for, to put it shortly, it is not too late to get into Asian local bonds back, because there is room for them to further appreciate from a currency perspective, and also from the perspective of holding the bonds actually increasing in value because yields will continue to grind lower. Policymakers, especially the central banks around the region, have committed to accommodative policies because growth is moderating here, inflation is moderating here, which goes back to what I said earlier about the stars being aligned for Asian local bonds. So I would say that it's an attractive investment class to actually put your money in. And I think one last point about Asian local bonds is that they are a low volatility asset class compared to equities, for example.
So you've got the dollar weakening, so conversely, other currencies will strengthen. So when you look at Asia, what's at the top of the list in terms of the beneficiaries or / winners?
Yeah, no better place to start than Singapore. In fact, if you actually observe the price action, if you had the chance to follow Singapore bonds, be it Singapore government bonds or Singapore corporate bonds, they behave almost like fixed deposits. They've been on an upward trend for the past 1-2 years. And one of the key reasons for this is because a lot of foreign investors see Singapore as attractive and safe investment destination. And going back to, the theme about diversification away from dollar assets, Singapore is a AAA country. Let's not forget that. And it's a real AAA country, in fact, with our strong fiscal finances as well as, our very stable policies. So this is why over the past 6 months to 1 year, we've seen a lot of inflows coming into Singapore-based assets, And a large part of it actually goes into our bond markets.
How much was this triggered by the Moody's downgrade of the US credit rating?
Yeah, so to be honest, if you're talking about the actual, what it actually means, what this downgrade actually means, what Moody's has done is to actually align its rating with the other two major agencies, which respectively actually downgraded the US in 2011 and 2023, if I'm not wrong. So materially speaking, it does make a difference, but it does shine a spotlight on the problems which the US government actually confronts, which is, its unsustainable fiscal trajectory. For a little bit of context, if the US were to continue on its current fiscal slippage, its debt will be higher than Greece by 2030. So this is how serious the problem is. Well, it's not going to default its debt anytime soon. That's not what I'm saying, but it does show how problematic this issue is. It's not going to be solved anytime soon, which is why other high-quality destinations such as Singapore or some of the Asian economies will become relatively more attractive.
I've got on your list, in your report, among the top winners, the Taiwan dollar up 8% year-to-date against the US dollar, followed by Japanese yen, Korean won, and then Singapore, the Singapore dollar. I'm just curious as well. With a weaker currency, typically you would say it's better for the exports. It's more competitive in that sense. So how does that play out when you look at these export-oriented countries, Taiwan, Japan, Korea?
So when it comes to, the fate of the export-oriented economies, I would say that, the bigger factor at play here, of course, is the result of ongoing tariff negotiations between China and the US. Because, as we know, the trade and manufacturing system in Asia is actually deeply integrated. So China is the big brother here. If China sneezes, the rest of Asia catches the flu. That is something that we cannot deny. So if we have a positive outcome from the tariff negotiations, or at least a steady state, which is what we are enjoying right now, I would say that this will result in benign outcomes for the export-oriented economies such as Taiwan, Singapore, and as a result of which this would mean that there is stability for our risk assets as well, including our currencies.
Okay, so talking about China, how's your approach towards it right now when you look at all the structural issues that are still being resolved?
I'll just do a compare and contrast here. I think 6 months or 7 months ago when President Trump was elected, of course, investors started feeling a bit skittish, a bit worried about China because the resulting trade escalation, the inevitable conclusion was that this would have a deep negative impact on the Chinese economy. But fast forward 6 months later, I think China has dealt with these trade negotiations with US very well, and they have learned from their lessons over the past 4 years. And most importantly, the policymakers come with a toolkit, fiscal support as well as various forms of support for the domestic economy to prevent or to actually alleviate any negative impact that would actually arise from tariffs, which are punitive. So it has given some level of confidence to investors, which brings me to why I feel actually on balance bullish about Chinese assets. It has kind of suffered over the last couple of years because of various challenges domestically, like for example, the fallout from the real estate sector. But they are now trying to reinvigorate the tech sector, which will be a major driver of growth in the coming decades. So in combination, I would say that things look good. Valuations are cheap on Chinese risk assets. Although the bonds are a little expensive, the yields are a little low. But I would say that this is one of those places where you park your money there over the medium long term. The upside is definitely very strong.
All right, more signs of China turning around. We've been in conversation with Goh Rong Ren. He is the fixed income portfolio manager for Eastspring Investments. Rong Ren, thanks so much for your time and insights this morning.
Thank you.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance. To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.